All right, we're live. Thanks for everyone standing by. I've got Nicolas Lares from Insur3Tech. We're talking about getting LES today. One of the neat things so if you follow Nicolas on LinkedIn, lots of really good input and insights all around different elements of property management, specifically, and then obviously it relates to insurance, but not just about insurance, but a whole bunch of other things that relate to property management. This is how we got introduced through other conversations we were having. So thrilled to have you on the show today. Everyone that's listening today. Oh yeah, well, thank you. If you're catching us in the live, add any comments in there. Comments make it very interesting throughout. Happy to have you guys to showcase your comments and see if you have any questions about insurance. As we get into the conversation here, hell yes is an interesting conversation because the way Nicolas and Insur3Tech position insurance, it's a little bit different perspective than what you may have thought of before. And so I think the exciting conversation to have around here is the evolving nature of insurance, how it's being structured, what it means for organizations, how it can create profit, create NOI. And I know at least 3 different companies are running captives right now, and those captives are super interesting when you consider how that can evolve in terms of like even a tax strategy and a tax planning. So insurance in itself is like, it's not just buying a policy anymore from a person. There's a whole lot more to it as it relates to your balance sheet and the profit that you create. So very interesting conversation. Looking forward to that today. Again, if you're catching us in the podcast, if you're catching us on LinkedIn later on, any comments you add in there, or the podcast, Apple or Spotify, if you leave any comments there or favorite us or do any of that kind of like goodness that helps us gets noticed, that's super helpful for other people to find us. And of course, if you are on the live later on, add any comments and Nicolas and I will get notified and we can jump in and put the conversation. This is brought to you by IRIS-CX. IRIS-CX is remote maintenance inspection software for property management. Help you see the problem before you dispatch that truck. Help you scope the site before you send out your team to go do the make ready. In all these cases, we save you a ton of time, energy, effort, and money. So we speed those things up. Now, without ado, Nicolas, a bit about your background and tell us a little bit about how you got into founding Insur3Tech and where that idea came from, the gap in the market, all those things. And we'll go from there.
Yeah, totally. So there's, running joke in the insurance world, which I've come to find out there's also one in the property management space as well, where no one typically goes into it intentionally. You kind of fall in by accident. You work in it for a year or two, start to come to find out, right, people are awesome, it's a great industry, and then you end up sticking around and having a lot of fun. So, it wasn't my intention to get into the insurance space. I dabbled a lot, high school, grew up as an athlete, played baseball collegiately, came down to really decide, hey, do I want to do this, right, as a career, shoot for the major leagues, spend 7, 8 years in minor league buses traveling the U.S. with a bunch of, guys eating peanut butter and jelly sandwiches for lunches and dinner. Decided wasn't the right path for me, wanted to do something else with, right, what I felt like I had the internal skill set to do. So pivoted my senior year in college, had no clue what I wanted to do. I jumped into the tech scene on college. My campus had a essentially startup accelerator program for college students where they could kind of come in, learn about how to take an idea from 0 to 1. A lot of local companies also would come in and say, hey, we're working on building this product or solving this problem. How would you guys go about doing it? Ended up being headhunted from there for a very large IT cybersecurity firm based in Miami. They own the naming rights to the Heat Arena called Kaseya. I was the last one hired before COVID really kind of ramped up across the U.S. So I was the first one let go and was sitting around looking for a job. I found myself dating a girl that I couldn't afford to take her out to dinners on the weekends. So I'm like, let me try to get, into something, whatever I can find. I'm just going to jump into it. And my best friend at the time, they were working on ensuring Amazon's logistics network. And it was right during COVID, right when everybody stopped going out and shopping. They were just solely ordering stuff online, having it delivered to their homes. So the market was growing, it was ramping up, and they said, hey, we could, use somebody on the team who can help us kind of scale this. So, jumped in, got licensed, and just really fell in love with the insurance industry. It's something that everybody really needs. It touches every industry. So people get it, they understand what it is, and there's a real value. It helps people sleep better at night, knowing, they're covered in the event something, bad happens. Well, after a couple of years in that industry, the market took a turn for the worst, very similar to what is going on in California and Florida right now in the property insurance markets, where every traditional carrier saying, hey, this isn't working for us. We're calling it quits. We're backing out, right? And the industry that I was in, unfortunately, there wasn't, state or local government entities that could kind of come in and fund an insurance program to keep people's homes insured. So what we had to do is we had to get creative and say, hey, we've got, thousands of businesses, delivery companies that need to find insurance within the next 3 months before the program renews. How are we going to keep them in business? So we essentially had to develop a program where we could take every single operator who we were insuring, bundle them together as a group, pool their risk together, and allow them essentially to stand to benefit in the event that that company generated a profit at the end of the year. And at the same time, right, if there are any additional losses, like the traditional captive would, right, they can come out of pocket and pay additionally if they needed to from there. But people who are not in insurance typically don't realize that there's an alternative to just paying a traditional insurance company, where at the end of every year, if they don't use all of the funds in terms of what they collected in premium to pay out in claims, there's a vehicle where people can actually get that money back. And that's something that's like really opening to a lot of people that they don't understand really exists. I had no clue about it until I got into insurance. And once I understood that business model, I was like, man, this is the best way to do insurance. Why isn't this the way things are essentially done from the beginning? Why is it that there are traditional insurance companies that are always the first option, right? And we'll collect your premium. If something happens, we'll pay out. But then at the end of the year, if they generate a profit, they keep it and it goes back to their shareholders, where I thought that was a little unfair. So my whole idea was, hey, what industry can really benefit from something like this, where captives are starting to spin up, people understand the business model that's profitable. So doing research, I came to find out that renters insurance had the highest profit margin of any insurance product that existed in the entire ecosystem. So started off there just to prove the business model that says, hey, if somebody's paying for insurance, odds are an insurance company is making money off of that, right? They have been for decades, right, in the resident liability sector in the industry. So started off with that model, pitched it to property managers, owner operators, anybody involved as a stakeholder in the real estate industry, where I said, hey, let me prove to you that every dollar your residents pay to live on your properties, I can route that back to you as NOI at the end of every year as a form of a profit distribution that your company can essentially take ownership of, instead of all of these, right, insurance companies that have existed for decades being partners, right? Well, we'll insure your residents for you. You manage the asset, you make sure things go according to plan, and we're here if you need anything. Well, 9 times out of 10, residents go through their lease term without ever having to file an insurance claim. Right. And insurance companies are standing there saying, great job, keep up the good work. We love being your partner. But they don't really share any of the upside profit back to whoever owns the asset or who is managing of it. There's admin fees in place. A lot of companies will do that, where residents charged 15, the operator or manager collects 5, but then the insurance company takes the 10 and they pocket whatever's left at the end of every year. That's where we're different. We still charge residents 15. We're giving the operator or the manager that $5 admin fee, or we'll match whatever it is that they're collecting now. But that $10 a month that we still collect at the end of every year, if there's any sum that's left over after we pay out for claims or deal with expenses, we simply redistribute back to them, and we make our money right on the invested income. That's what most people don't really understand about insurance, where yes, they can turn a profit on underwriting, where they collect more in premium than they pay out in claims. But every insurance company, they also invest the total amount of funds that they're collecting throughout the year in investment vehicles, right? Short-term treasury bonds, simple 3 to 4% interest stuff every year. But that adds up when you're talking, hundreds of millions of dollars. That's a pretty profitable business that if you can just generate profit off of that, you can do pretty well for yourself. So that's kind of where we make our money. And we take the underwriting profit side and just say, hey, this is just gravy, right? We don't want to capture this. This should go back to the people who actually manage and operate the risk that's involved in the industry. You should be the one to stand to benefit from that, not us, right? So we're kind of just making a product that used to be a very fair and, aligned incentive, where people who collectively pool their risk together should be the ones to benefit and only pay that at cost. We're delivering insurance at its true real cost right back to the industry is the best way to kind of slice and say what we're doing in a nutshell.
And a conventional insurance company would argue back that we underwrite these. They would argue back that the underwriting occurs and the kind of year-over-year accumulation of investment income is there to support a year when there are more claims than there are proceeds from premiums to support the event.
Yep.
What happens in that situation?
So the program is fully reinsured. A lot of people don't realize that insurance companies actually pay for insurance themselves.
Right.
So they can essentially isolate the bad years where in the event that they do have to pay out more in claims than they collected in premium that year, there's a reinsurance company who's waiting on the sidelines for them where they'll come in and step in and pay for those claims from $0 down. So insurance companies like to make people think, hey, there could be a down year. We're going to have to come out of pocket more, right, for claims than we collected in premium that year. But they're not the ones who end up having to actually pay for that. Everybody has heard of or knows of like the Zurich and the Swiss Re's of the world, but you don't buy insurance policies from them. You buy insurance policies from Lemonade, from State Farm, Geico, and then they place their book of business with the Swiss Re and the Zurichs of the world. So they stand to just benefit right from the upside. If they turn a profit, great. If there's downside risk where we collected less in premium, it's all right. Our insurance company or reinsurer is paying for it anyways. So there's no loss to them in the event that happens. And
so if I think about it in terms of like the opportunities, like there's captives and there's the kind of conventional approach, like, is this kind of like a cooperative captive? Is that a way to think about it?
So the formal term, at least on the resident piece, is what's called a risk retention group. It's essentially very similar setup to a captive, but it has none of the downside risks. So a captive is really, you're essentially taking ownership of the insurance company and then you're hiring somebody to manage it, but you're on the hook typically if the company doesn't perform well, where whoever owns or is essentially taking ownership of the captive has to come out of pocket for any downside risk. So captives typically have less of a structure on reinsurance on the back end, and it operates as like a true, win or lose scenario. Whereas a risk retention group, what we're doing is we're just isolating the profit side, and then a reinsurer on the back end is covering the downside. So captives are usually, I take my money, I insure my own assets, and whatever's left over, I take. Risk retention groups are typically somebody else pays premium, but I retain the profit to insure essentially a third-party asset that's involved, right? In this case, the property. Where that's kind of like the two differentiating factors between captives and risk retention groups.
Risk retention groups. And so when you take a look at the insurance market that's out there, and so is this something that's out there everywhere? People don't know too much about it. Like, it sounds like common sense in terms of like an option or an alternative. Why isn't this not everywhere?
Yeah. So, the first part is really understanding how the insurance world works. It's, insurance companies have their distribution network typically through brokers, right? And middlemen who take margin or a piece of the premium that the end user ends up paying for. So, what I tell people, they always ask me, hey, why have I never heard about this before? Why hasn't anybody done this? Why are you the first one to present this to me? And I just like to point, and make them aware, hey, if you were a broker, an insurance broker, and your business model was essentially built off of taking margin right off of insurance premium, if somebody came to you with a business model that said, hey, every available margin of income we're giving back to your customer and essentially cut you out of the picture, what would you do? Would you present the option that would essentially eradicate your business model where you don't make any money at all? Or would you stick with the traditional method where the ecosystem is built off of, people taking money out of the pot as it goes from reinsurance to insurance to broker to end user or customer, right? If we cut out all those middlemen and that margin now unlocks profit for the end user, why would a broker present that to anybody? Why would anybody be made aware of that if the whole industry is essentially at risk, right? If somebody comes in and presents that model, which is what essentially we're doing.
So it makes it feel a little bit disruptive when you have the conversation in the market. People
totally
feel like this is black magic, right?
Yeah, and it really puts us, a lot of times the first thing people do when we present our model to them, the first conversation or the first phone call they make is to their broker. And they say, hey, have you heard of something like this before, right? Why haven't you presented this to me before? Most of the times, brokers might not be aware that this model exists. There could be distribution channels where, hey, instead of our customers earning, 50 to 60% profit margin, we'll keep the broker involved and just say, hey, we're going to pay you out maybe 40 to 50. So if their relationship still wants to be maintained, they still have a comfortable face or somebody that they trust who's essentially working with them that they have been for, several decades. We can still maintain those relationships, but as long as the end customer, our or owner or operator is aware that they're leaving margin on the table by doing that, that can still be done, right? But a lot of times they'll initially push back and say, hey, there's no way that they're generating that much money. Like, put yourself in the insurance company's shoes. What about the risk? What about the downside? They're either just not fully aware of how these programs work. Not every insurance professional is privy on how captives and risk retention groups, a lot of them just make their bread and butter on pitching traditional insurance carriers that they're used to and comfortable with. So yeah, although it's, a disruptive model, the game of insurance has existed for centuries, right? We're not doing anything different as a risk retention group than a traditional insurance company is. The only thing that we're doing different is who ends up with the dollars at the end of the day. That's really the only thing, right? So people think and come to me and they say, hey, this sounds too good to be true. This is too new of a concept. It smells fishy to me. That doesn't sound like there's any downside risk. And that's because they're almost in like a Stockholm syndrome where they're held captive by the people who have just essentially been teaching them how the industry works for years. And no one stood to benefit by changing it, really until now.
And so when you look at because often we talk about the uncontrollable expenses, right? The insurance, taxes, interest falls into that category. Yep. So now we're kind of saying that, hey, there actually is some controllable influence you can have from an insurance perspective as it relates to NOI. And that is a different paradigm in terms of what everyone's accustomed to, because it is kind of like, call my broker, I get my number, I might call 3 other brokers, but we have a number and that's it. I might be able to save my premium on it, but typically there's a trade-off in terms of what I'm accepting for coverage. And that's not normally how we do things.
Yeah, totally different. And for most people, the insurance industry, it's extremely regulated. All of the contracts and the policies that, name your insurance company presents to you, they're carbon copies of each other. They all read the same. All the verbiage is the same. No one would be able to essentially build a business in this industry if they started excluding things and cutting people short of coverage. So we offer the same exact policies that like the big players in the space do. We offer the same coverage types. We even offer more added coverage, since we essentially give residents the ability to opt up for added coverage rather than like most people in the space or suppliers. They say, hey, your leases require, right, 100,000 limited liability for a resident to move in. We offer that for them. What about if they want to insure their own personal belongings, their own furniture? What if they want to insure their pet? What if all these other options where the conversation is, hey, we provide this, but all this extra stuff, go get it elsewhere. Sorry, we can't help you. Right. That's not only margin that they're leaving on the table from the bare minimum, but there's so many added layers on top of it that residents are already paying for this stuff. It's just not through a company that you're getting any direct benefit from working with. So that's like another layer on top of just the bare minimum NOI. There are all these other kickers on top where people think, hey, renter's insurance can't make that much money. It's not really going to move the needle for our portfolio. But when you take into account the total spend that residents are paying for insurance to other companies that you're just not aware of because you're focused on is the requirement, you're losing out on it. I mean, it adds up to $200 to $300 a door, right, in added NOI just by presenting the full amount of options that a resident could or would want to live, in a rental community, but they're just going and paying for it to somebody else. There's a broader wall that's being spent that isn't necessarily covered. Even roommate insurance, all those other kind of things, right? Yeah, exactly. And it's really just, what information, what you know and what you don't know, right? Yeah. So a lot of what we're doing, it's obviously very educational. We're teaching people how the insurance industry works, what options are available to residents. And we're saying, instead of piecemealing every bit of it and using different layers of suppliers across the way, you can really just centralize it in one single solution, offer every potential benefit, and then on top of it, stand to benefit right on the upside when it generates a profit. It's really a no-brainer, I think, when we present our option to people versus the current solutions that are out there.
So then, and is there a case where you guys charge an overall management fee for all the profits that are generated? So you guys are gonna make money too. So how do you guys make money? If everyone else is making money on underwriting and the investment returns on underwriting, and you're returning that back to your clients, you guys make money.
Yeah. So the second piece is the return on invested capital, right? So all the premium insurance companies collect throughout the year, that leaves them room to invest it and earn, 3 to 5% interest as that money is sitting in a bank account, right? That's essentially where we're taking our money. So it's really at no cost to our customers or residents. it's the same amount of money, right, in terms of what everyone's paying right now. So we're not adding additional fees or added cost on top of what people are paying for now. We're just really offering it at its pure cost potential, right? Because our money is being made elsewhere. And frankly, like I said, if you're earning 3 to 5% on hundreds of millions of dollars, you can see how that scales to add up to be pretty significant amount of income, over time.
Yep. Okay, cool. So you're making money. The insurance profits, the premium so then it's better to characterize the premium profits are going back to the client as a kind of like a wash at the end of the year on a pro rata basis, presumably.
Yep,
some sort of thing like that.
Exactly.
And then
so like if a portfolio comes to us and say, hey, we have 10,000 units, and for example, that year, using round numbers, if we're insuring 100,000 units in total, if their 10,000 units contributed 10% of the premium we collected throughout the year, they're then going to collect 10% of the profit distribution that we dish back out to customers that year. So it is all based on a pro rata basis. We do have the option where if it's a larger portfolio and they say, hey, we think our residents are safer than the rest of the industry. We think we operate our properties. We have more risk management and safety practices in place. We want to carve out our own portfolio, and we want to be responsible for the total profit that our portfolio generates from our residents. We can carve them out and have their own isolated cell if they want to do that. It operates more like a captive structure. We're still minimizing the downside, where we're still reinsuring that cell along with the larger portfolio of the entire industry that's syndicated together. But some people think, hey, I'm willing to take the bet that my portfolio is going to be more profitable than, 1,000 other, owner operators out there that band together. So that option is there. But then again, right, you take the risk where you could have one bad claims year and it can wipe out, a lot of your profit potential. You could still get guaranteed income because that admin fee is there every month that you're collecting on. But just depends on how risky, right, the operator or owner of that portfolio is, and what they think of themselves compared to the rest of the industry.
Yeah, I think, and the fair word is probably risk adjusted, right? Because if you've got a 1960s product versus a 2024 product, you might have different risk profiles for that particular asset versus what you can control and not control.
Yeah, but it's not even about the asset itself. It's really right on that product. It's just, how well do you know your residents?
Yeah.
Right. Do you think you know your residents better than other operators? Do you think, are you in a class A, solely luxury building where, a lot of your residents, instead of paying $100K, in minimum liability limits, they upgrade to $300,000, where, you think you can make a lot more money off of that than, your traditional market? A lot of questions, but we just, we want to do things as fair as possible. We lay out all the cards for everybody to really understand how it works. And then just like residents, we give them the ability to pick and choose what they want. We're doing the same for our customers, where you can pick and choose, how much risk you want to take on. With that case, you get more profit. But at the end of the day, our business model works because the industry is just essentially built for, upside potential.
So when you talk to, given that kind of the world is moving a lot towards fee managers versus owners, is this kind of like an opportunity for a fee manager to, I would say, take a portion of I guess this question is, who's normally the buyer? Is it a fee manager or is it the owner?
So it's really, I tell people it's whoever comes to us first.
Yeah.
Right. So we really hit it off really quick with the owner operator sector, where, they stand an answer to themselves. They can make decisions a lot faster, than if there's a third party involved that they have to, negotiate or discuss, potential, solution with. So owner operators, really quick, super easy, love us. We grew really fast in that sector. Now the owner and the manager side tends to be a little different. We see a lot of the bigger managers, the top 25 NMHC, they tend to be very reliant on their current suppliers, if you will, right? I get it. Their whole business model is to, reduce risk at all costs. Also coming to find out, there's a lot of stuff going on, behind the scenes where, if a certain supplier is giving them an extra, piece of the pie that, a mom and pop operator aren't getting just because they have the scale and the leverage, that's there too. But a lot of owners, who come out to us and they say, hey, great, I'm going to connect you with my manager, and you guys, figure out how you're going to essentially onboard, do the workflow. So we're seeing a lot of owners kind of push us upstream and saying, hey, manager, I know you have a preferred solution in place for this. 80% of the time, it's like the PMS out of the box solution where like
Yeah.
Yardi, Appfolio, Entrata, they all have a renter's insurance solution, but it's
Yeah.
really like bare bones. You're barely generating any income from it. A lot of times those are really easy conversations where an owner will say, hey, we'd love for you guys to use Insur3Tech. Our workflow is the exact same, right, of every other operator out there. So it's easy to essentially transition from using those platforms to using us. And at the end of the day, we can now turn an income stream that was just leaking out to a third-party insurance company. And now an owner is now benefiting and capitalizing on that income potential. And in some cases, right, we're even paying the property manager more than what the current solution was paying them before as well. So it's really a win-win for both sides. Same goes on the flip side, right? If we reach out and we talk with a manager first, they bring us in, they go to their owners and say, hey, guess what, guys? We just found an added NOI lever that we can now generate for you. Expect more distribution at the end of this year because now we're working with Insur3Tech. And they use that as a bargaining chip at the table when they're competing with other hired fee managers and saying, hey,
Sure.
we work with suppliers that we can generate more of an NOI than other providers who aren't using a company like Insur3Tech. So they're using that to go out and get market share and use it as a bargaining chip at the table when pitching to other owners.
Is it typically classified as amenity revenue? How's that revenue classified when it comes into the management organization?
So some people have currently like a form of an insurance income from like the admin fees.
Right.
Some people are just adding it as a new income lever in their underwriting or pro formas. Where, hey, this is significant income that we weren't seeing before. So it's being added as a secondary, line item to their income slot, including with rent and other ancillary income services.
Yeah.
But given it is, right, it's an optional program, they can't classify it as a guaranteed ancillary income like parking or amenity fees would be. So there's no way to really guarantee the income potential from it. We're seeing portfolios that use us. About 80% of residents will just opt in with us because it's so much easier than them having to go get insurance from an independent insurance company and then come back with a COI. It's just, hey, we have insurance. What option do you want? Sign your lease and you're enrolled. Framing in the conversation is so much easier for both the resident and the leasing staff that people just select themselves. But a resident could say, hey, the bare minimum for me, if it's $15 a month, that's all I want. Sign me up for that. Could be a resident, right? Class A luxury. They want more limits. They want to insure their own belongings. They could go in and say, hey, I'd rather pay $50 a month, right? To add some limits to protect my contents directly as well. So it's a fluctuating, right, profit potential income, but the margins really work the same. Doesn't really matter what product they opt in for. It's between 30 to 50% income potential for most things renters insurance.
And that insurance, that flow back to the buyer is a kind of like because it's not dividend. It's not a dividend payment. It's a profit
distribution, just like an LP in a syndication fund, right?
Yeah.
And but you don't have to put any capital up front. You kind of just opt in and say, hey, I want to use you. And then, right, once we get your, ACH and bank information, just expect, an ACH, wire to come and hit your bank account before the end of the year, whatever profit distribution's there.
So then given the markets you guys cover, as I understand, I probably need to fact check this, but like Greystar has a captive that they run and all of their customers have access to be able to buy insurance to that captive. Yeah. That's going to come down to rates. Rates feel very standard when you go to market, at least the ones when I talk to brokers. Yeah. They feel very standard and the difference is service. How do you guys compete on that?
In terms of like compared to captive, what internal?
Well, if all prices are the same, right? Mm-hmm. Or somewhat similar, then if the differentiation is on service, because the need to have it is kind of felt. Feels to be somewhat indifferent from the resident perspective, right?
Right. Yeah.
So the resident doesn't feel any difference. The buyer, being the fee manager or the owner operator, they have a cash difference. So are they going to feel? And since the rates for it all, let me get my head clear here for a second. The rates for it all pass through to the resident. Mm-hmm. Profits generated from that distribution channel. That's going to generate profits that go back to the buyer. That's going to come through as a profit share. Mm-hmm. My question was, like, are the rates And then given that everything is competitive at the resident rate level,
Yep.
the rates, and that if you're going up against Greystar's captive, those rates are going to have to be the same at the resident level.
Gotcha. Yeah. So the differentiating factor, compared to the Greystars who spin up their own captives and do it themselves, some owners receive a form of profit generation from that. Sometimes the ownership group doesn't see a single dollar of it. I think it depends on the relationship that exists between the owner and the hired manager. Right. The second piece that we're really proud of, that we can say no one can really compete with us on actual profit margin potential, because we place our policies straight to reinsurance. If I had a title for what I do professionally, I'd consider myself a reinsurance broker. So the same way, if you think of the CDO markets for mortgages and lending, banks lend out individual mortgages and then they package them together and then sell them out to individual institutional or bigger funds on the back end, and they make their spread. We can take all individual policies and risks at the resident or property level, and we plug it straight into a reinsurance company on the back end. There is no middleman margin in the middle. So a lot of times, these captives that exist out there, I'm assuming what Greystar did is they went through a third-party captive or captive manager where they then plug them in with a reinsurance company behind the scenes. So odds are, if there's a captive manager involved or somebody who's acting as a broker in a capacity, they're probably taking some piece of margin out of the middle. So instead of Greystar potentially taking, 50% profit margin on their captive, they're probably taking 30. Doesn't add up for small portfolios, but a captive size of, Greystar with millions of doors, 10 to 20% profit margin swing could be, a significant difference, in income potential. But it really just depends on, what who and, hopefully if people find out about us before they find out about, other captive managers out there, that 15 to 20% profit differential could be huge for their portfolio.
Well, particularly since it's deemed as being an uncontrollable expense at this point in time, right? Now you can actually influence the outcome by making a different choice, by having a different choice. I'll put it that way, right?
Yeah.
So when you go talk to folks, you don't win every deal you pitch. What kind of objections do you get? What kind of pushback do you get on doing it differently?
Yeah, the first one is always, the hump over it's too good to be true. A lot of the buyers in real estate, they're very risk averse. They don't like to be, first mover or trying something new. They like to be, the last one after everybody's already tried it and proven the model. So at first, getting them over the educational piece of knowing, hey, who's your current supplier now? Do you think they've been making money off of doing this, working with you the past, however long you've been using them? Really just helping them understand, who's standing to benefit today, because somebody is. And really just finding them at the right time where they have really the capacity to kind of sit down and look at the numbers and the comparison, where if they look at their books and say, hey, we are paying an insurance company, X amount of dollars every year, just to insure our residents or pay for a master policy that then we can then upcharge residents on top of, I tell them, look at whatever that dollar number is and then assume half of that can come back to you at the end of every year, and really just kind of walking through their own numbers, helping them understand, hey, the money's there. Somebody's already making it. It's just not you right now. And whenever you're ready, whenever you have the capacity, to have the conversation and engage and do, a rollover from whoever you're using now to us, we're here for you. So, the pushback is really just having them feel comfortable with understanding that there really isn't, risk associated with doing this, because we operate and it's structured the same way that their current provider is structured. So there's literally no difference on paper, on, execution, on availability in terms of managing and operating the insurance company. We're plugged in with the same back end providers that every other name your renter's insurance company uses on the back end. So if you're using Assurant, ePremium, Resident Shield by Yardi, they're all plugged into the same back end networks, right? They all share the same back end providers.
It's the same, 12 companies that reinsure everything in the world or whatever the number is.
Exactly.
The same ones that all hold up doing their thing.
Exactly.
So then when you talk about when you go to market, you mentioned owner operators, you had a lot of success there out of the gates because they feel it. Is there a certain size that you like to go for that has a buyer that is more inclined to make this kind of decision?
Yeah, I'd say like 1,000 to 10,000 units is, I think, really kind of our sweet spot.
Yeah.
Anything bigger, there's typically a lot of corporate, decision making or some type of
Yeah.
bureaucracy involved where, hey, I have to, run this up the chain of command. It's usually not a team of maybe 10 people, where, they can group together one morning, make a decision, and, make a call from there.
Yeah.
So yeah, that's just what we tend to see about, like, I guess the internal structure of the organizations we're working with is
Mhm.
anything too big tends to move very slow. We are in conversations with a lot of big, managers or portfolios, but the sales cycle on it is just taking, years versus, weeks or months compared to
Yeah.
the smaller sizes. So really just, took a couple of years to really understand the dynamic, like what Dean mentioned, the relationships, right? What relationship dynamics do we have to work through or understand? Who's benefiting from this currently? What information are you getting from who, right? Where if you plug us in, their income from working with you is just pretty much gone from one day to the next. So understanding that has been really insightful. The first 2 years of building this out and working through
Gotcha.
it.
And so then as a kind of a case study, so if you think of like 1,000 unit PM, and they've got, how much does renters insurance cost for the audience, cost per month roughly?
On average, it's $15 a month per resident.
Right.
Insurance companies walk away with about $10 a month for that. So, they're probably taking $120 a year and then assume profit margin of, just say 50%, right? $60 annually per resident.
So then if we look at like from a just a numbers perspective to make it just to make it interesting for people who have 1,000 units. So 1,000 units, you're looking at $15 a unit on a monthly revenue, 12 months. So like $180 a month, a year, per resident.
Yep.
And call it 1,000 units. So you're $180,000 in revenue, in insurance fees,
Yep.
premiums,
Premium.
And then like conceivably they could see, up to possibly 40,000, 50,000 come back.
Yeah.
I know we can't make promises, but like, what is the pitch? Like what I'm trying to get at is is the juice, at what scale does it make it worth to consider the change, right? Because like at 50 units, it might not be worth it, but like at 1,000 units, it starts to sound pretty interesting. You've got $180,000 of rental of insurance fees for just resident insurance. So when does it start getting really interesting for your buyers?
Our cutoff threshold is typically 100 units or more.
Okay.
There's enough meat right on the bone for them to stand and benefit. While at the same time, right, since our whole business model is essentially a vehicle that generates profit for our customers, we have to also make sure we can filter and make sure whoever's joining is going to be a net benefit to the rest of our customers and not pull money out of the company or pull away from our value out of generating profit. So we've come to find out, typically anything under 100 units, one kitchen fire, and that entire portfolio is in the negative in terms of profit potential. So we like to say, 100 units or more. If we have a conversation with somebody and they're 30 to 50 units, we can tell them and say, hey, do you have anybody else who you can just simply partner with and say, hey, let's come into this together. We just need in total 100 units as a sum. We don't need a new LLC to be wrapped around it. We just need, in terms of onboarding, 100 units together. And then from there, we can route ACH wires to one owner and then the other to the other owner. But just as a whole, that's what we see tends to make sense, for the rest of the group. But 100 units or more, I mean, sky's the limit really in what they can earn. And the cash flow in terms of how we deliver, income to our customers. Again, residents currently pay about $15 a month for a renter's insurance policy. $5 of that, essentially goes as guaranteed income to managers or operators for essentially administering the program to residents, So that's guaranteed income no matter what. $60 a year, that's paid monthly cash flow every time the rent cycle is essentially ran, So that's the first part of the cash flow. Then the $10 a month that's left over, we invoice from the manager or the owner operator every month. And then we put that essentially in a fund that just kind of sits there where if claims, or expenses are claimed against, we take the money out of that bucket. But on average, our profit ratio, like I said, it's about 50% profit margin. So out of every $10 we collect a month, we're really only paying about 5 out in claims and expenses throughout the year. So
Mm-hmm.
then that $5 a month that essentially accrued and turned into profit at the end of every year, we send a $60 check back to our customers as a profit distribution. So they collect $60 a month, or no, $60 monthly, right?
Mm-hmm.
$5 a month, and then $60, boom, at the end of the year on top of
Yeah.
that, out of $180 spent by residents, right?
And then everything's backstopped by the reinsurance, and so you give your reinsurance.
Exactly. So you never have to come out of pocket. A lot of times too, a lot of these companies out there, they do like a master policy where they have to pay for every resident, whether they buy insurance from them or not. And that's just like a sunk cost that they're just paying for. So like we're not charging property managers or owners. If a resident doesn't buy insurance from us, we're not going to charge you to still insure them because we're verifying and monitoring COIs on the back end on an ongoing basis. Most PMS or out of the box solutions that do this now, they verify on upload COI, right? Resident moves in, here's my insurance policy. Yeah. But if it cancels 2 weeks later or the resident decides, I don't want to pay for insurance anymore, there's a gap that most PMS solutions don't really monitor and actively insure, right? There's a policy in place throughout the remainder of the lease where, you know, we're coming in, we're monitoring and we're running reports on a monthly basis to confirm insurance policies exist for every lease. So that way, in the event somebody cancels their policy and says, hey, I'm trying to pull a fast one on the property, we're going to send them an email and say, hey, we found out your insurance policy canceled for whatever reason last month. Here's an option for you to get reinsured or send us a new and updated active COI so we can make sure you maintain and you're in accordance with your lease obligation for this renter's insurance policy.
Very interesting. I mean, because I had Mason Mello back. He was with someone else before last January, and we talked about just that whole tracking of the insurance status within a renter agreement, and that's what they do, or what they did, or what that company did. And so, like, it is a gap that happens that people are kind of starting to solve, or they're aware of. And when you take a look at these things here, like, where do you find like people that are most apt? So we talked about the size, right? We talked about the kind of like the I'll say the organizational structure, but like at what point do people seek to consider their insurance framework as a way to generate NOI? Is it a function they're kind of like up against the wall saying, hey, we're underwater this year, we got to find more revenue? Or is they just say, hey, I heard this guy Nicolas talking on the show about how we can make money on insurance. Like, how are people start rethinking the way they look at their insurance solution and start saying, hey, we can get some money from this? Like, what does it take for a buyer to go, I need to make more money, and this is the way we can make more money, and we're gonna be uncomfortable with the change because the money is worth it?
Yeah, really depends on when people enter the market. I think the cycle of when they went and acquired or underwrote and bought a property. I think depending on how compressed their cap rate is or how tight their margins are, if their interest is going up or in their insurance costs are going up. People who are in positions where, hey, we're running thin on margin, we got to find something quick without raising rents or adding fees. They're really on top of it and they're coming on as fast as they can because that's the difference, of them surviving another year or two versus them not. But I think the real driver and what people are seeing is they're using our renter's insurance program as like the first layer of defense for their own underlying insurance policy. Right. Gotcha. It's a no-brainer that everybody's insurance policies have gone up, the past 4 or 5 years. Yeah. Whether you filed insurance claims or not, it's gone up. So what a lot of people are trying to do is they're saying, hey, how do we give us the best shot at a decrease come renewal next year? Right. The way to do that, at least what the industry tells you, is to not file claims. Right. The less claims you file, the more likely you are at essentially getting a decrease on your property. Although the past 4 years, that's come to find out hasn't been the case either way. Yeah. But what a lot of people are saying, they're going to say, hey, the profit we're going to be generating from our renter's insurance program, we're going to use that as the first dollar for every deductible for our actual property insurance policy. So what they're doing is they're unlocking a source of income and funds where, hey, if we have to actually tap into our insurance policy, let's hold off on that. We'll use the funds we got last year from our renter's insurance, and we're going to keep paying that out of pocket. So what it ends up doing is it ends up driving down their own insurance policy costs because they now look like a better risk to traditional insurance companies because now they're not tapping into their insurance policy, right? Or filing claims because the profit that their renters essentially are generating on their policy costs are funding their $25,000, $50,000 deductible, right, per claim, that they can tap into that now instead. And now we can start to change the trajectory where instead of insurance costs going up every year, let's give us the best shot at renewing at a decrease. And then from there, right, we can then go in and open up the conversation of, hey, now let's look at a captive, right, for your own properties, where now you use your renter's insurance as the first layer of defense for paying out claims or anything that goes wrong. And then if you don't have to tap into your property insurance policy, that means now that carrier is generating a higher profit margin on you, right? So how do we take that money and then keep it in-house, where instead of now that insurance company going from maybe generating a 10% profit margin because we used to have to file claims, now they're generating a 20 to 30% profit margin because you stop filing claims on your property policy now. And at that rate, right, it starts to bring in the full loop, where if we can have residents, right, or owners generating profit from their residents' insurance costs, if they can come in and say, hey, our own insurance costs, if we don't use the funds, let's keep that internally as well, to the point where we can almost not fully eradicate insurance, because obviously that's never going to be, unfortunately a thing, but at least we can just take, 10 to 20% chunks out of each piece. And that adds up to being, significant savings once you look at it across the full stack of everybody who's paying for insurance, on one asset.
So play this back just to make sure I heard it correctly. So because you have insurance now, so bad things happen, right? And they're hard to avoid. And a lot of people haven't, they're paying out their premiums, they're paying out their thing, they pay their premiums. And then when there is a claim that needs to happen, they've got to go and write a big check. And that comes out of NOI. And it's unplanned. So right now, what you're offering is that if you're kind of judicious about this whole framework, you can go and collect your renter's insurance. That's going to create a distribution, not only your $5 distribution, but an additional distribution beyond that. That's going to create available capital to pay for and budget for any sort of premiums that you may need to any sort of repairs or kind of work that needs to be done prior to creating a claim that otherwise might occur. So then people who are judicious about it would take that additional funds and the distribution, they would put that into a capital account that they would then use to pay for, major events that were unplanned for, instead of just paying that out as NOI or taking that as NOI. So it's like creating contingency for these capital events that are unplanned, and rather than using insurance as a backstop, you're using that distribution as a backstop. Those events, because then by not creating a claim, you're going to have your overall policy become much more insurable or desirable insured by lowering those policies.
Yep. So you see how that all kind of ties in, where it's just little amounts that obviously, right, the industry is very aware of the power of compounding, where, right, if you can, instead of your own insurance costs going up, 20, 30, 40% year over year, what if they only went up 5 to 10%, right?
Because
how much of a differential would that be in terms of your NOI from there? And then on top of that, hey, what if we generate a profit on the renter's insurance, right? What about the years where we don't have any unexpected or unplanned events come up? Hey, we just found new money where we can now reinvest into, maintenance, or we can reinvest into, improving the asset, that we've been deferring maintenance for, X amount of years because the margin's just been eating up, right, from somewhere else that's been a cost that's been growing. So a lot of things, I don't tell people, hey, here's how to spend the money that we're generating from you. Obviously, every portfolio and asset manager makes a decision on what they want to do with that, but at least we're opening up an opportunity or some form of leverage that they can then use as like the first layer of defense to tap into instead of going out of their own pocket for whatever reason.
And if nothing does happen, they could use that for their capital expenditure budget to prevent things from happening, the roof, the boiler, all that kind of stuff, the inspector to make sure those PMs are done, rather than kind of living things in an at-risk situation right now, where a lot of folks are actually deferring all those things or punting them to the next year, that they are still carrying a risk that boiler may fail. And the argument for punting out that capital expenditure is that, well, if something does go wrong, we've got insurance.
Right.
But that's not really the way to be thinking about it, because then you're just saying, I am going to make a capital plan decision making about available funds, push it out to next year because I'm unable to pay for it right now or unwilling. And I want to accept the risk that of something going wrong. And if it does, I accept the outcome of that risk, which is my policies will go up and I'll be less insurable.
Yeah. It's it's almost like a vicious, like a negative feedback loop.
Yeah.
Where like one bad thing trickles into another thing, turning into a bad thing. And then it kind of just keeps going down south. And then you know, 1 year to the next, you look around and you're like, what happened? And it's like, well, if you had just one layer of defense across a bunch of different things that went wrong over time, that could be the difference between ending up in 4 or 5 steps back to just ending up in 2 steps back, where like your net difference is right now we're +3, where if we didn't have something like this in place, it's like it just keeps cascading down and down. Where if we had something at the top layer to stop it from cascading, you know, we would look different as a company overall in 10 years, right? If you assume that happens every year, that's the difference between a company either plateauing or going in the negative on margin versus outpacing the rest of the market for 10 years.
I think and for an expense line item that you kind of feel helpless towards, it really creates a bit of, I mean, I don't want to go as far as saying a sense of empowerment, but certainly when you feel helpless around a cost, you kind of feel you feel unempowered. But now by creating optionality around what's possible in terms of an outcome, those that are seeking to outperform, those that just want to keep the same way, they're probably not going to buy. But those that are either feel the pressure or the desire to outperform their peers are going to try and find those pennies. And those pennies, they convert into dollars very quickly and rationally. There's no risk to this. This is just like the way the math is distributed versus the conventional distribution of all those funds.
Yep. And it totally changes the psychology where once you go from simply paying or buying insurance to owning an insurance company, or at least participating in the upside of an insurance company, you start to change how you view claims, how you view risk, to the point where, hey, I've been investing in safety practices and risk management, for our teams as a whole, and I'm not getting any benefit of that because I could just be dealt a bad card, and all of that, is essentially wasted. So it really changes the psychology where, you take your average person who's paying $3,000-$4,000 a year to insure their own home. 10 years ago, if they were only paying maybe $1,000, maybe that leak in the roof, I'd rather just handle it out of pocket. I don't want to deal with an insurance company because it's not worth my time. Where all of a sudden, I've spent about $30,000-$40,000 over the past 6-7 years. Next time I see a leak in my roof, I'm filing a claim. I'm going to make sure I get that value, right? So it turns into that whole psychology where people just think they're either being taken advantage of, they're getting the short end of the stick. But it's not news to anybody that insurance is really an inverted reward game, where the 90% of people who play the game well, who are safe, are subsidizing the 10% of people who don't play the game well, who are unlucky, right? That's how it's built. But there shouldn't be a third-party entity that wins either way, no matter what you do, right? It should just be those 2 buckets where if something happens, there's a vehicle in place to protect your downside. But if everything goes according to plan, you should benefit and have some type of gain, right, where you're rewarded for that. And just that psychology alone, I think, is a big thing that people are starting to realize and wake up to.
Because you might start to do some of the preventative maintenance work that you've been putting off. Maybe that boiler unit needs to get service this year, and maybe go even maybe not going to replace the boiler, but I'm going to do an annual service on that thing, more frequently, or those kind of things that otherwise get pushed out now get considered as a priority item because I'm a stakeholder in the insurance results. So you think about it, and I don't know if that culture cascades down to the site level, but ultimately, if everyone understands that they've got a piece of the action, then that asset manager or the regional VP, they can start, imposing that kind of culture around ownership for that particular asset.
Yeah. And I think, it also trickles down to a sense where, there's a lot of talk in the industry where people are talking about burnout. People feel overextended. They're feeling overworked, where a lot of times I think it's just, people are operating under really tight margins. They feel pressure and the tone in conversations and team meetings were like how important and how urgent everything that they do is, where if people felt like, hey, if things go according to plan or not, we're going to be okay. There's something in place to help out with that in the long run. Like the tonality in conversations changes. People feel more appreciated. They feel like the work that they're doing matters because they're going to see an upside in the event that something goes well. Where it's just like everybody's overworked, overwhelmed.
Yeah.
And I think just having again, it's just a small difference that really makes a big outcome in terms of how it's transitioned right throughout the industry, where even just having a safety net like this can translate. I'm not saying it's going to trickle down and be the answer to burnout that the industry is dealing with, but like it at least is one piece of the puzzle where, hey, if we can at least make conversations 1% less risky, 1% less urgent, where people feel like they can have a conversation where if 1 out of 100 things goes wrong, it's completely on them. Let's just take a few things off of the table to lower the heat, right? Lower the urgency in the conversations. And maybe it'll start to trickle into people feeling calmer, right? If things don't go according to plan, or knowing that it's okay, right? If they get dealt a bad card, because there's something in place where they're going to benefit or be protected either way. So it's, something I've been thinking a lot about internally as kind of a second order benefit, right? To kind of take
ownership is a unique state of mind, right?
Yeah.
You feel, I guess this is maybe a separate conversation, but like that conversation about helplessness, like helplessness is despair, right? And despair is can lead to depressive state.
Yeah.
And so like, one of the things that separates humans from the whole animal kingdom is we're the ones that can hope, right? No one else can hope like humans can. And so if we can negate the sense of despair because you're feeling helpless about something you have to manage, then you start to kind of like feel an upside about hope. And so I'm not suggesting that insurance is the path to hope, but it can be a mitigation for some of the sense of despair and helplessness and the other side of things.
Yeah. So or maybe, like us unlocking the opportunity where people think, hey, our supplier is not in it to generate a profit from us. What other products and services that are out there where there's a lot of profit margin that these suppliers are essentially making, right, and working with us? What other industries, what other verticals, what other products can start to follow suit?
We start engineering partnerships out of the funds flow. So that
exactly.
I
think that's very exciting. I think that's an opportunity that can lead to, huge benefit to the entire industry. And really just, again, it's just aligning incentives, frankly, where everybody knows we're in an industry that's very lucrative. There's a lot of money to be made into it. And if we can align incentives where, hey, we can all make money, I get not every supplier can operate like an insurance company and invest, premium, right, on a monthly basis that they can generate a return off. But, there could be some things, here and there that people can just apply the same model, same concept. Maybe they just didn't think about it before, where it just unlocks, a different conversation for the future of that market or that product.
Outstanding. You look back at your past and your kind of career and your growth and all those things along the way. What kind of advice would you give yourself, a younger Nicolas, where you are today?
Man, I think the one thing that I did growing up that I would just tell myself to change is more so just kind of listen to myself. I think, we all have, those gut feelings, conscious, whatever you want to call it, your conviction. I think I made a lot of, fork in the road decisions where I put other people's expectations or, an idea of what I thought I should do and didn't listen, internally. Where I think if I would have started doing that from a lot younger of an age, I don't know, who knows where I'd be. Everything happens for a reason. I think I'm on the right path of where I need to be today. And I can say that with conviction. But I just, sometimes I question, what if I would have done that? What if I walked away from playing baseball just a couple years before? Where would I be now? What if I did things that I thought, led me in my curiosity to kind of chase those things that are kind of pulling me in that direction instead of what I thought I should do because, that's the beaten path, et cetera. But I mean, that's the only thing I would say, but I really wouldn't want to change anything, man, because it's, it's been a beautiful journey. And obviously life is a lot like driving a car, but you can only look in the rearview mirror to see where you've been. You can't look ahead to know where you're going. So I've been enjoying the journey and the process so far. And, happy to be a part of this industry and growing into it and educating people on, how insurance works, what the potential of it is, and changing the framework and the model of how people view it. It's been a fun ride so far, and we're just getting going, and I can't wait, to see what it looks like 10, 20 years from now after just being in it for just, 2 years at this point.
Well, I think it's pretty obviously it's funny how people we've had on the show who are former athletes or high level athletes, and the commitment, the conviction, the grit, all that kind of stuff that helps you get through those moments is something that translates very frequently into business, right?
Yeah.
Like conviction around your ability to achieve your objective, and the understanding of the trade-off that comes from hard work. And I think self-reflection, like athletes do a ton of self-reflection, whether it's looking at video, whether it's like looking at your swing, your throw, whatever it is, your positioning, especially baseball being so situational. But like what you did then and there, and having that all recorded and available for reflection is not something we really generally get to appreciate or to understand how that's part of the way it's done. Yeah. And you have to live with your mistakes, and they're played back to you. Right.
Yeah. No, it boils down to, are you able to make adjustments, right, when you get new information? And I think that plays at the heart of entrepreneurship, that plays at the heart of being an athlete, and really just, life in general, man. If something happens that doesn't go according to plan, how do you respond? How do you adjust to it? Yeah. That hits at the core of a lot of different, things. But playing a sport was just a way to kind of, to increase that feedback loop, to understand the importance of making those adjustments versus, life. Sometimes it takes a while for you to make a decision and then see how it impacts you later down the road. So, being an athlete where each pitch is an adjustment that you have to make, where the feedback cycle is rapid. It really helps you build that framework and mental model of, how do you apply that to other parts of your life. And that's all it is, just making adjustments.
Well, as a Chicago guy, you probably got to read a lot about Greg Maddux and his era with the Cubs. And you read about Maddux and how, we got a timeout here real quick, but like his ability to recall and replay and tune a pitch count to the outcome that he's looking for 2, 3, 4, 5 months from now is pretty remarkable. And so the strategy and the thinking around that's not lost on me. It's awesome.
Yeah, totally.
Awesome. Well, who should we have on next? It's always a fun part of the conversation.
Yeah, the one person, like I said, I've seen at trade shows and just really on top of the ball in terms of what they're doing in the industry is the team at Rentana, Julie Blanc. Got to give her flowers. She's, just running into her at some events. And, when I first got started, she gave me a lot of insight, a lot of feedback that was really, really powerful for me and just starting out. So she's somebody that I'd recommend. And then I think the Hiley team, HYLY, they're doing a lot of cool stuff just because my tech background and being in the startup space, we had a lot of really big Fortune 500 companies come to that startup accelerator program I told you about. Yeah. And they all were like, hey, we're trying to figure out how to get AI embedded in our system. And the first step was you got to stop using pen and paper, right? You got to get everything digitally. You've got people who have been working there for 20, 30 years who, they still, don't know how to use Microsoft Word or like the basic, of computers. And I think, what Hiley's doing in getting all that stuff built digitally from day one to then be able to bring in the adoption of AI. I think there's a lot of really cool stuff that they're doing there just because I saw it. Fortune 500 companies are struggling with that. I can only imagine, what mom and pop operators or smaller companies are just kind of stuck in really, the digital limbo of being able to actually apply AI. Cause again, that's one of those things where it's a small, percentage difference, but the outcome could be huge, over the course of, decades. I think what they're doing is really cool stuff. And I've seen the issue that they're trying to solve, firsthand, before getting an insurance. And I think it's really powerful as well.
Very cool. Well, we should highlight, we've had Julie on before. She's worth a touchback. I haven't chatted base with her for a while, and I know just raised around. So I'm excited. It'd be worthwhile getting back in touch with her. She's awesome. Very cool. Well, thank you, Nicholas. This has been fantastic chat. And I look forward to your posts on LinkedIn. They're super insightful. I think you do a nice job of provoking the audience with respect to what you're putting out there. So definitely connect with Nicolas. Well, thanks everyone for listening today. Thank you, Nicolas, for everything you brought today.
Yeah, appreciate you having me on, Guillermo. It was a great time.
This is awesome. And the conversation of insurance, as we chatted earlier, like it's not a helpless expense line item. There are options. There are ways to reframe how it can come together, and it can be beneficial for you and help you solve a number of different compounding problems down the line that can begin to, if you rethink the root cause or one of the root sources of it all, you can maybe solve a bunch of different problems down the road by just rethinking your frame around the conventional approach to how it's been managed. If you're listening to the podcast listen to the podcast on Apple or Spotify, just follow, subscribe, all those things help it make it easier for people to find the show. And then if you're on LinkedIn, as I mentioned, on the live or on YouTube, any comments we'll get later on, and we'll be able to respond to them. Thanks for listening, everybody. Thanks, Nicolas. This has been awesome, and have a wonderful day. Take care. Cheers.
See ya.
Bye. Right on, man. This is great.